Hello and greetings to Dr. Alif. My name is Mr. Rinnai from Section 2 with my matrix number BB24110113. Today I will be doing individual presentation for financial statement and ratio analysis for the company MW Malaysia Holdings Berhad. Firstly, for the introduction, MW Malaysia Holding Berhad is a leading direct selling company in Malaysia. This company was established in the year of 1976. This firm also has been listed on Bursa Malaysia main market since 1996. With a vision of helping people live better and healthier lives, the company has been offering a wide range of meaningful, unique high-quality products in which their main business activity includes selling various products across several categories such as nutrition and wellness, beauty products, personal care, home care, and home tech. Throughout the year, Amway brands and products have firmly put their position as the industry leader through numerous achievements and awards that has been won both locally and around the world. The next following part are the summary of financial statement and ratio analysis. Main source of data and information that I use in this presentation are obtained from Amway Malaysia Holdings Berhad annual report, which I obtained from their website. I do analysis for 3 years from 2022 until 2024. So the computation for ratio analysis in this presentation includes profitability ratio, liquidity ratio, solvency ratios, efficiency ratio, and market ratio. Moving towards the data analysis, I will present about the profitability ratios for this company. Firstly, the ratio return on asset. This ratio measures whether the company used their asset to generate profit more efficiently or not. As you can see in the chart or in the graph, the return on asset is much higher in 2024 and very low in 2032. This shows that the firm efficiently utilized its asset to generate profit much efficiently in 2024. The formula to compute this ratio are net operating income or expenses before income tax are divided with the total asset. Next ratio in profitability ratio are return on equity. Formula to compute return on equity is the net income will be divided with the common equity. Return on equity are used to measure the accounting return on common stakeholders' investment. From the graph, we can see that the company used shareholder equity to generate profit very efficiently, especially on the year 2023, which amounting 37.68% compared to 2022 and 2024. Next is the net profit margin. The formula to compute net profit margin is the net income will be divided with the sales. As we can see in the graph, the net profit margin for 2023 and 2024 are very similar. For net profit margin, the higher amount is the better. For 2023 and 2024, 8.2% income is generated from each ringgit of sales. Same goes to the gross profit margin. It is also the same as net profit margin, which the higher ratio is the better. The formula to compute this ratio is the gross profit will be divided with the sales. The ratio in the year 2022 are quite low. Meanwhile, for 2023 and 2024, it is also quite similar as net profit margin. This ratio tells how the company control their expenses to generate profit more effectively. For example, in 2024, the company managed to retain 25.19% of their revenue as gross profit. Now I will present about the liquidity ratio. Liquidity ratio is used to measure the ability of a company whether they're able to meet short-term financial obligation or not. In liquidity ratio, I will compute current ratio and also quick ratio, or also known as acid test ratio. Formula to compute current ratio is the current asset will be divided with the current liability. Using the current ratio formula, the ideal benchmark must be higher than 1.0. This is because the higher ratio is the better. For MW Malaysia Holding Berhad, as you can see in the graph, all current ratio are higher than 1.0. This indicates that the company able to pay or able to meet their short-term financial obligation. But as you can see, the most ideal current ratio are during the year 2024, which amounting 2.10. Next is for acid test ratio. For acid test ratio, the ideal benchmark is also higher than 1.0. After comparing all the 3 years, the highest ratio can be seen in the year 2023, which amounting 1.31, and the lowest can be seen in 2022, amounting 0.78. Hence, this means in the year 2022, the firm has only 0.78 ringgit in current asset after deducting with inventory to cover every 1 ringgit in the current liabilities. This means in the year 2022, the firm unable to use current asset to cover their current liability. Next, I will continue with solvency ratios. The ratio in solvency ratio are debt to equity ratio and interest coverage ratio. The formula to compute debt to equity ratio are total liability will be divided with total equity. For debt to equity ratio, lower value is the better because it shows that the company has less financial risk. However, this depends on the company. After I compute this ratio, we can see in the graph that in the year 2024, the debt to equity ratio is the lowest, which only 0.71. This means low amount of debt is used to finance the company. For interest coverage ratio, I was unable to compute this ratio because interest expense value is not provided in the financial statement, where the formula to compute interest coverage ratio requires net operating income divided with interest expense. Therefore, I am unable to compute interest coverage ratio. Next is efficiency ratio. In efficiency ratio, I compute asset turnover ratio, inventory turnover ratio, and also receivable turnover ratio. Efficiency ratio are used to determine how well the company use their resource to generate revenue. For this ratio, the higher value is the better because it means that more sales are generated per ringgit of asset. Comparing 2022 until 2024 ratio, the highest asset turnover ratio are in 2022, amounting 2.73%. Next is for inventory turnover ratio. The formula to compute this ratio is the cost of goods sold will be divided with inventory. As we can see in the graph, it is very obvious that in the year 2023, the inventory turnover ratio are the highest, amounting at 0.74. Meanwhile, the inventory turnover ratio for 2024 and 2022 are quite similar. A high value for inventory turnover ratio is good, but too high might indicate that the company experienced an understock. The third ratio in efficiency ratio is receivable turnover ratio. The formula to compute this ratio is net credit sales will be divided with average account receivables divided by 2. Receivable turnover ratio are used to measure how efficient the company collect payments from customer. Based on the graph, the highest receivable turnover ratio is in the year 2022. This means in 2022, the customer collect payment very efficiently compared to the other 2 years. Higher ratio indicates much faster collection of payments from customer. Lastly is the market ratio. The earning per share or EPS have been calculated in income statement, and I obtained this information from the annual report. Based on the table, the highest EPS is in the year 2023, which amounting 70.52 EPS. This might mean that Amway Malaysia Holding Berhad are more likely to produce more profit during the year. Investors usually use this information to compare companies of similar business nature in order to track the financial performance. Meanwhile, for price to earnings ratio, I unable to calculate because there is a lack of information in the annual report, which requires information of market price per share. To summarize overall analysis, this firm actually has a good to average level of financial performance. Amway Malaysia Holding Berhad still have a lot of areas to improve in order to enhance more on their financial health, stability, and profitability. So the recommendation I could give to improve is the company should take into consideration qualitative factor such as workforce productivity, debt to equity management, the competitors, and the company plan and strategies, cash flow management, and also many more factors. This is because the qualitative factors plays an important role in improving financial performance. Next recommendation is internal organization should put the effort to analyze other industry and other competitors' growth potential in the market in order for them to forecast or predict economic condition so that they're able to fight in the market. The external factor, which also includes inflation and interest rates, need also put into consideration because it brings risk towards the company.